Hi, this is JP Newman of Investing on Purpose, and today I'm with Ryan Moran to talk about exactly where are we in the economy right now at this moment. Ironically, I think Ryan and I have switched places. Usually I'm more the optimist, and I'd say right now we have some headwinds, and I'll tell you why in the episode. It's a really short episode. I think you'll find it intriguing, and I'm going to give you a suggestion of something I think will be really helpful for you to watch as well, that I think will really change your thinking. Hope you enjoy the episode. If you do, like and subscribe.
All right, so we're going to make this quick.
Okay.
But we need to do an economic update.
Okay.
Because when we've done this in the past, we did an episode where I was like, JP, I'm pretty scared.
Right.
And you were like, voice of reason, this happens all the time.
Right.
And then we did an episode where I kind of take a stance. I feel like the worst is over.
Right.
I feel like markets didn't bottom as low as I thought they were going to. We did disagree on how much the real estate market was going to come down. I think I won that bet.
It's not over.
I thought we'd see a 25% pullback, which we're around, at least in Austin, we're about there. I don't know what it is in other markets.
Right.
But you've kind of teased that maybe we've switched places a little bit, that I'm like, I feel like things are a little bit stable. I'm kind of encouraged by, I think there's some really attractive presidential candidates. I'm kind of hoping that maybe we get somebody that isn't named Trump or Biden.
Right.
I think that sentiment is still low, but it seems okay. So
Yeah.
I'm more in like, okay, we're in a stable place. I'm less scared.
Yeah.
But when I said that to you, you made a face.
I did.
And we switched places.
A little bit. Yeah. I mean, I still say, like, I think with our last conversation, I said, the next 24 months is going to be rocky, but we don't know how rocky it's going to be.
Yeah.
And remember, I think we're 6 months into the 24 months. So it's not that I totally changed my position. I just think that I'm actually starting to see the crest of the wave start to fall.
Okay.
And Ryan, here's where I'm seeing it a lot that's concerning, is that, first of all, we still haven't ripped the Band-Aid off of the fact that we printed $7 trillion. We still haven't ripped that Band-Aid off of the money supply.
So let me poke a hole in that.
Please.
Because we're destroying that now. The Fed is reducing its balance sheet. It raises interest rates, and that money does get destroyed.
Right.
We haven't destroyed all of it,
right,
but we're in a contraction period.
We are.
So it's not like that money's just floating around.
But here's my point.
Okay.
About the Band-Aid. I didn't say we haven't started, but we haven't ripped the Band-Aid off.
Okay.
We've lifted the Band-Aid. We can feel a little pull.
We feel the hair being pulled. It hurts a little bit.
But we haven't ripped. And I think that what you're seeing, and you may not be seeing it, but I am seeing it. I've seen it in my apartments, is that this inflation isn't a small thing.
Mm-hmm. Right. Okay. Yeah.
We're seeing the interest rates, they're going to be high. They may not keep going sky high, but even now they're high relative. They're not high historically. They're just high relative.
And they're high relative to the price of assets.
Right.
If you were to buy a house right now, it's still really, and the price has come down, but the monthly payments are absurd.
Right.
And so like one of those things has to break.
Well, that's you just actually nailed my exact thesis. What I'm seeing, Ryan, across the board in my business is expenses are up everywhere. It's not, everyone just keeps talking about interest rates, but my insurance has doubled. My property insurance has doubled.
Yeah.
My taxes have gone up. My employee overhead has gone up by 20%. So right now I have a business, in the real estate business, that because of all these increased expenses, my revenue is not meeting my expenses. It's upside down. So only two things can happen right now, Ryan. Prices have to go down on the asset, or expenses have to go down.
Mm-hmm.
Because an investor is looking for a risk-adjusted return. No investor is going to buy something that loses money every month, whether it's sheer strength or whether it's an apartment building. It's the same fundamentals. No investor is going to buy or not for a high price. They may buy it at a discount, and they think they can turn it around, but no one's going to buy it for today's prices.
This makes sense.
So what I'm seeing right now, because right now, Ryan, I am selling 5 properties. And I'm looking to buy, I haven't found much to buy. I made one offer. I'm lending money right now, so I'm really active in the marketplace. And here's what's interesting right now. Buyers are trying to buy. So there's capital, and the prices, the market's actually really efficient and you're 25% in Austin's about right on 25%. But here's what's interesting. So the market's actually speaking really clearly. It's very efficient at what values are today. But here's what I'm finding. People can't close. I've had 4 people come in about the same price on my deals, and they can't close because they can't successfully raise their equity. So everyone thinks capital is that easy. It's there. It's not really there. Now there's a nervousness or an unsure that are we really at the bottom or not.
I see.
I can tell you, I don't believe, based on at least in my market right now, that we're at the bottom yet. I think there's more pressure that needs to go, because still, even at the new prices, at the new adjustment of the 20 to 25% discount, revenue and expenses don't make sense for an investor yet. So one of those two things, again, expenses go down or prices continue to go down.
This makes total sense based on why you make that face to me when I said I feel like the worst is over, because I am seeing the squeeze too in businesses. The expenses are up, fees are up, and revenue is stable, maybe a little bit down.
Exactly.
So there is a squeeze on P&Ls.
There's a squeeze
right now.
Again,
The very fast markets like crypto, stocks, like things that are more liquid, I feel like that pain happened a while ago. Like it happened 6, 8, even 12 months ago. And it was just such a boom, 30% correction, 50% correction, 80% correction in the crypto markets.
Yeah.
Where I feel like that has now flatlined or stabilized. But more conservative, stable assets like businesses and real estate, they always come last.
Right.
And we saw the price correction happen really fast. But what you're saying is that there's still like a P&L squeeze. The businesses are still having a hard time, and they're probably going to have a hard time for quite some time. And I do think that's going to be the case for another 18 to 24 months.
A lot of equities, just again, the PE ratios of stocks, like cap rates on real estate, they just were so like and it's probably healthy. This is the part where I get, I said in my last clip, it's like, this is capitalism and this is market efficiency. They probably have been overblown for a long time. There's a great documentary on YouTube called Easy Money. It just came out, and it talks all about how, having just too long of a period of easy money is, one of the big reasons that bloated the value, all the values, because money was virtually almost free. And so to me, that's ripping the Band-Aid, as money is no longer free. By the way, interest rates of 6, 7, or 8% are great. Like historically in real estate for the last 50 years, 7 to 8% is a normal interest rate.
It's great with proper asset prices.
There you go. That's the ripping of the Band-Aid, Ryan. That's what I'm talking about. So with normal prices, it's healthy. We're cleaning things up. It's all going to go up, but there's got to be some pain, because the people who paid for their businesses, their stocks, their real estate, the prices that were from a year ago, it's probably not the same value today. And it's interesting, right? I'm less on the equity side. So you're right. I can't say confidently with what you're saying that maybe the worst of the price corrections have already happened in some of these more liquid assets.
In really liquid assets.
Yeah. So it's possible the market is so efficient that it's already priced that in. I could see that as a possibility. I also do know that I believe that the middle class right now and the lower middle class are being squeezed harder than ever, harder than even the pandemic right now.
Harder than the pandemic.
Well, food prices, everything's up. So your rent is up, your food is up. And so consumers, that money that they had when they got the check and a little more savings, and there's still some money, but that's quickly dwindling, where people are going more and more to their credit cards. I got you. So you're going to have a lot of consumers squeezed everywhere. And so something has to break, and something has to give.
That makes sense to me, because when you have a recessionary period, the one good thing that happens there is lower prices.
Yeah.
And we haven't seen that. We've seen it in assets, but we haven't seen it at the grocery store.
You're seeing just the opposite.
Online. Yeah,
they're saying right now, like in like a lot of like the bread lines and a lot of the places where people are going for food and for shelter, that the pressure now on these nonprofits to provide food is worse than it was during the pandemic. That people now are squeezed and more desperate now than they were during COVID, when there was no jobs and everything was locked up, because they actually had a single mom who said, I usually could live on $100 a week on food, and now it's 170. So I'm using my 100, but then I got to supplement and go to like I got to go to a food, a nonprofit food place just to supplement to feed my kid.
Yeah. Does this approach how you manage the market? I mean, for us, it's been, okay, we have to be really lean. We've got to be really protective over profit.
Yeah.
Which is just good business, but it becomes extra important right now.
Yeah.
And at the fund, it's, we can't invest in businesses that aren't profitable.
Yeah.
Whereas we'd have more of a risk tolerance for growth companies or early stage companies. And now it's like, if you're not profitable, you can't feed our are people.
Yeah.
And so that brings asset prices down too, because there's less of an appetite for the high risk thing.
I'll say the same language. So I have a property. You did walk this one. It's in Salt Lake City.
Yeah,
I'm selling it right now.
You're selling it right now. It feels like yesterday
I know
that we walked it together.
And I'm selling it partly just because we made our return. Even in this market, we're going to make a reasonable return. It would have been a 70% return annually a year ago. Now it's going to be like, if it sells, again, you got to make sure that actually 18%. So it's a lot less.
Wow, that's a big difference.
But our pro forma to the investors was about 16%.
Okay.
So even though it would have been a home run, now it's a single. But guess what? Investors get their money back with a return.
Yeah.
That feels really good right now, because I do think that markets, again, it's not doom and gloom. I just think that there has to still be an adjustment. So if I could take some risk off the table, return some capital to investors, that feels really good to me.
Yeah.
So I said to my partner, who you met Brennan,
Mhm.
and I said to Brennan, I go, because there's still a bunch of units and it's doing great. The building's full. I said, can't you sell the dream of like to the next buyer of like, there's still half the units that need to be done. He said, JP, you can no longer sell the dream. That was the last market.
Whoa.
There is no selling the dream.
Yeah.
He's like, the lenders, the banks, nobody's looking at the dream. They're just looking at the numbers on the pages now, which is so different than the last 10 years. The language of my business has been literally, fix up 10% or 20% of your business, apartments in this case, and sell the dream.
Yeah.
And then the bankers would bank the dream. Everybody, equity would, everybody was into the dream. The dream is over.
Now, there were two things that you said has to happen. One of two things has to happen. Prices come down, or what was the other one?
Well, expenses come down.
Yeah.
Because to adjust on the prices, either prices come down, expenses come down, or you can say a combination of both of them.
Okay. So in either of those cases, you have some sort of a recessionary environment. We've already had the asset price recession.
Right.
And so you either continue that trend, or the expenses have to come down, which looks like unemployment goes up. Like one of those two things has to break, is what you're saying.
Exactly.
Yeah.
You got it.
I think we have about 18 to 24 months before that's fully shaken out.
Yep.
Like from here.
That's what I'm saying. So
that's what you think too?
That's my feeling.
Now, I'm a real estate investor as a limited partner. Right? I don't do what you do, but I invest in the stock market, and I invest in Ethereum and Bitcoin, and I invest in businesses. And my approach of this has been, I view this as an accumulation period as a retail investor, right? So when I see Bitcoin under 25,000, I'm like, this is a good place for me to enter and be in for 10 years.
Yeah.
I see PayPal come down to 80%. I'm like, it's a good position for me to be in for the next 10 years.
Yeah.
So I view the next 2 to 3 years as an accumulation period where I want to plant seeds, work like hell, and have a really long time horizon. But you're active in the business, so the approach on your mindset must be a little bit different. I view it as good news. Like, I want to start new things. I want to buy things at a discount.
Well, I've added 3 new staff members in the last 90 days.
Okay.
So because I'm actually, the old saying, when things look the toughest is the time you got to basically accumulate money. So like right now, Ryan, I'm working harder than I've worked in 10 years. It's a really hard environment to raise money. Investors are nervous. They're scared, rightfully so. A lot of uncertainty. And this is the time that you have to accumulate investors, which is why I just hired 3 more people.
I see.
It's not the time to buy, but it's the time to be ready. And you have to have your war chest ready to go. So I'm having a lot of fun. I mean, so in my mind, I have 2 mindsets right now, Ryan. Protect the mothership, which is I still own apartment units. I still have a lot of assets I have to manage and do the best I can. And there's some real challenges now. I mean, prices are gone up. I doubt that insurance is going to ever go down. I think we're in a place of climate disaster after climate disaster. Remember, who pays for it? We do. And it gets packed into the rent. So every time there's a climate disaster and you see Houston gets flooded, you're paying that. The expenses are it's not the insurance company. The insurance company is just passing on the expenses to me, and I'm passing the expenses on to you. So think about this, so insurance is a lot of expenses may just never go down. Interest rates probably won't go down to where they were at, but there'll be some kind of stasis. But to answer I'm investing just like you. I'm actually buying crypto. I'm doing 3 investments this week that I still believe in. So I'm not hiding from the hills.
I'm glad to hear you say all of that, because oftentimes if this scared feeling, the anxiety in the market can keep people on the sidelines. And so they wait until things are good in order to jump in. And there's just never a perfect time.
There's never a perfect time.
There's one wild card though, JP.
What's that?
And it will be the does AI and technology create deflation and make things cheaper, faster, smoother over the next couple of years, which will still have a very rocky period, right? Because that will put some people out of jobs. It will be a change in a lot of marketplaces, but that could drive down the costs of things in industries that we can't even foresee right now. I like to bet on that. I think that's an optimistic view. Yeah. I think that when you have technology that make things more efficient and that brings costs down, that is a net. That's a good thing. There's one. That's the one wild card that I'm like.
So I love that wild card. And I'm an optimist, but here's the thing. And again, this documentary, Easy Money. Just watch it.
Okay.
But the thing we have to be careful with is, because I agree that sounds great, but what's happening even right now with their inflation, it's become an excuse for a lot of companies, Fortune 500 companies, just to charge more, and they're actually making bigger margins. So this continued trend, whether it's any political party, it's not a particular political party, but like this particular trend where the billionaires are getting 40% wealthier, and you can really see in the lower middle class having less and less like policy. And this is kind of what the things of policy between the Fed, Wall Street, the relationship between Congress, the Fed, the executive getting maybe a little too cozy. Where
you think that even now? I mean, I think Powell has pretty much given his finger to the market. I mean, I think
watch the documentary.
Okay, I will. I mean, look, my background's Austrian economics, so of course I tend to agree with what you are saying in terms of low interest rates artificially inflating asset prices. But it does seem like in this cycle right now, Powell was like, "Yeah, we're going to bring prices down."
Yeah, but it was and he tried to do it 5 years ago, and Wall Street told him no, and the president told him no, and that would have been the time to do it. But it could have been a lot less painful. The Band-Aid didn't have to be so painful. So, I mean, just to end, it's like, I think that we live in such an amazing country. I both agree America is just, there's nowhere else I want to live. I don't want to make any crazy statements, but it is so important that we make sure that, and this is where I think government has to do its best, and it's a really hard time, to try to create a playing field where entrepreneurs that are successful absolutely should reap the rewards, but just not on the backs. You don't want to gamify a system.
JP, you're going to give me a heart attack, man.
Sorry. You just want to gamify the system where you don't give most of the people a chance to live a good life. That's always been the American dream.
I mean, I know. Sorry. We said we were going to make this quick, but I mean, to me, that just means get the hell out of our way. Right. Just don't give special breaks to anybody. Don't put special rules on anybody. Right. And we'll all just let the marketplace figure it out.
Right. Which I love it, but that's not what's happening.
Because you see, your interpretation is that there's special rules for special people.
There are.
Yeah.
I mean, there are. And there are. And anyway, so that's a whole other political rabbit hole. But the real thing is what you really want from a healthy thing is that everybody at their level it feels like they have a relatively fair playing field. I don't think it shouldn't be a giveaway, which some people, on the one side, and you don't want it to be so gamified that it's the same people who just, because your point about AI can totally do that. I think AI can deliver that promise of cheaper cost of goods sold, less work, maybe 4-day work weeks, are already becoming the new norm. And I think that's all amazing for humanity. It's just the question is, how will those extra energy dollars of ease, how will they get distributed to human beings?
Well,
and that's a question.
Well, we'll find out over the next 18 to 24 months.
We will.
All right. That's a wrap.
Hi, this is JP. I hope you enjoyed the episode we just did here with Ryan. Some things to think about. I think the biggest thing to remember is there's always opportunity in every cycle of the market. If you like this episode, please like, subscribe, and remember, we're all over on Instagram, TikTok, YouTube, @Investing on Purpose. Thanks for listening.